Welcome to our monthly market report for May 2023. For the next several minutes, we're going to talk about updates on home prices.
And it's some of the best information on prices that we have recently received.
And then we're going to talk about inventory and foreclosures, and we'll round up with the talk about recession.
So, Robert, first let's look at this quote from Doug Duncan from Fannie Mae. He said this: on a quarterly basis, home prices rose as seasonally adjusted 1% in Q1 of 2023. The fact that prices rose slightly in the first quarter is evidence of significant pent-up mortgage demand despite ongoing affordability constraints.
And that's certainly some good news for real estate.
And I want the audience to think about something. Have home value declines stabilized? Look at the leading indicators that measure month-over-month home prices. I think we can make a case that stabilization is beginning to happen, if not already happened in home prices.
Yes, and as you look at this, some of the worst in-home price declines are behind us, right? What you can say for sure is that home prices are not in this precipitous decline. Black Knight said this: just 5 months ago, prices were declining on a seasonally adjusted month-over-month basis in 92% of major US markets. Fast forward to March, and the situation has done a literal 180, with prices now rising in 92% of the markets from February on.
And last month on the monthly market report, we talked about prices. Consider this an addendum to that. We want to give you the latest information on prices because we're going to start seeing forecast revisions. We're already seeing Fannie Mae's change in March. They said we might lose a little over 4% in value in homes throughout the country. And then fast forward to March, and they're like, wait, just kidding, maybe only 1% value loss.
I think that'll continue, and we'll see a year that'll show a flat on average nationally, right? Because as we know, real estate is local. And here in the IE, in San Bernardino, Riverside, and Victorville, those values are certainly going up, and I suspect near double digits in some places. So, Yvette, why is that?
Because of lack of inventory, which reminds me about something going on with inventory: foreclosures.
Let's turn our attention to inventory and foreclosures, right? There's been a lot of information in the last few weeks, recent foreclosure information that we should cover.
And I think this graphic sums it up. If you have been following the monthly market report, you've seen it before, but this is a look at the buyer's market versus the seller's market. Where are we right now? The months of inventory of homes for sale in this country going all the way back to the late 90s.
And we went through this crisis, right? Obviously in 2008, and the inventory rose in the country, turning into a buyer's market. And then over the last several years specifically, we've been in this seller market that is still here today. And so that's important to remember, right? People are looking to put their homes on the market. We need more inventory. We're at a time where things that are priced right are selling quickly with multiple offers throughout the country, especially in the IE. But oftentimes we hear information, or there's information in the news that says, well, inventory is going to rise because foreclosures are coming around, right? And there was a new report that came out from Adam middle of the month, and the title was US Foreclosure Activity Continues to Climb in Q1 of this year. And that's true, right? Foreclosures are going up. That's factually correct, but it's misleading when it's taken out of context, right? Headlines start popping up like more Americans are going to lose their home to foreclosure as foreclosures on U.S. properties rise, right? Foreclosures are on the rise. Foreclosures jumped 22%. Repossessions hit a high of the last 3 years, right? Foreclosures jump. Is another wave about to flood the housing market, right? And we're here to say, in fact, more foreclosures should not be happening, especially in the IE, and we have a lot of thoughts about that.
And a couple of things that are critically important so we can have that conversation based on the facts. First piece here, there are over 1 million fewer foreclosures in the last year than the average heading into 2020. So anytime you look at information, we always want to go back to 2017, 2018, and 2019. The last 3 normal years, I would say, in the business, and the average of foreclosures in those 3 years, 598,000, almost 600,000 foreclosures each year. And we don't wish that upon anyone. Certainly our hearts go out to those that are experiencing it, but it's in fact in our business what happens. Well, we go through 2020 and COVID, and the moratorium comes about, and you literally can't foreclose on people, and those numbers drop through 2020 and 2021.
Exactly. And as we're coming out of the moratorium, foreclosures will rise, but not at the rate that's going to dramatically impact inventory and shoot us up into a buyer's market. And it shouldn't rise specifically in the IE and San Bernardino because of the equity that homes have gained over the past few years.
So whoever's writing those headlines obviously didn't look at this graphic. This is a look at US properties with foreclosure filings going all the way back to 2005. If you go and see that rise up there during 2008, during the housing crisis, when back then there was over 9 million foreclosed distressed properties, deed in lieu, all the things that we know in the distressed sale category that happened. A lot of people hurt and a lot of people impacted by that.
And today we sit right here, a slight tick up. All right. So nothing like the headlines lead us to believe or lead you to believe. Being armed with the facts is critically important. Here the foreclosure activity by the numbers. 95,000 properties with a filing in the first quarter of this year. 65,000 started the process in the first quarter. And you see the rest of the numbers there, right? Our job is to help you understand the headlines that do more to terrify than they do to clarify what's actually going on. And remember, real estate is local, so what's happening in San Bernardino, especially, we got thoughts on that.
Our message is pretty simple. It's this, and I think Realtor.com summed it up pretty well. There's no reason to panic, at least not yet, as foreclosure filings began to tick up in late 2021 after the federal foreclosure moratorium ended. And the moratorium was enacted in the early days of COVID-19 when millions of Americans lost their jobs to prevent a tsunami of homeowners losing their properties.
Right. The job of forbearance was to give people a way to bridge the gap during COVID. And I think we've covered that extensively on the monthly market report, but it did its job, and that's a good thing. And as we kind of come out of this time, we can expect more foreclosures than we've seen last year, but not a number that would lead to a tsunami of homeowners losing their properties. Right? Since the time of the end of the moratorium and now, if you haven't lost your home but think you may go into foreclosure, think again. Right? Your home may have enough equity to get you out, and that's what we're talking about, is that equity.
So being educated, having the facts at our disposal is critically important in this market. So I want to go into our topic on recession. We're not here to say a recession is coming, when it would, how long it would last, or anything like that. What we are here to say is the talk of recession is going to heat up and continue to heat up as we go throughout this year. The economy is slowing down, the Fed working to slow down the economy. Here's the summary of the Fed March meeting. The summary came out in April. Given their assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year, with a recovery over the subsequent 2 years.
So looking at that, there are a couple of things that we want to understand. One, what defines a recession? And two, the question that we should all ask is, how will housing be affected? So who defines a recession? The National Bureau of Economic Research defines a recession, and they define it as a significant decline in economic activity spreading across the economy lasting more than a few months.
Is it 2 consecutive quarters of negative GDP, the gross domestic product?
Yeah. Yes, it's been that many times. Now, the question I want to get back to is, how will housing be impacted? This is really an area right now that I think it's important, especially if you're in real estate, to be a student of the business, be a student of real estate. That way, we study the market and have the answers to the tough questions.
Questions like, how would a recession affect home prices? How would it affect rates, specifically mortgage rates?
And staying a student in our field will help us bring the most educated answers to you, right? So first question, how will housing be impacted? Well, Bankrate sums this up, and I think they did a really good job with this. They said, during a traditional recession, the Fed will usually lower interest rates, and this creates an incentive for people to spend money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunity for home buyers.
It will affect people, but oftentimes, typically in our business, it's an incentive in the housing market. As we go through this, the Fed said a mild recession. So it's important to discuss what are the pros and cons of buying during a recession. Okay, what are the advantages? Pros include possibly less competition, lower prices, and lower rates could come out of that. The cons may be stricter lending requirements, certainly with some of the bank activity, like to see that, fewer options available, and maybe economic uncertainty now enters the picture. People think, am I going to have my job? Is my job going to be secure going forward? So these are things that we discuss with our clients and families. So when buying, they make a powerful and confident decision on buying a home during this time. Robert, can you help us answer some of those questions with the facts we do know? What happens with prices during a recession?
Well, the first thing we can say is that a recession does not mean falling prices. We've said this for a long time. Recession does not mean a housing crisis, right? We went back and studied, and the KCM research team studied the last 6 recessions, and we found that 4 of the 6 times home prices actually appreciated. Twice they depreciated. Once marginally in the early 90s. What everybody remembers is 2008 when homes lost almost 20% in value. A lot of people were hurt. And maybe they saw parents or loved ones, right? Millennials did, others that were hurt during that time. So when they hear the word recession, that's what we think of in this country because the meaning of the word recession changed back in 2008.
That's important. Our perception of a recession changed in 2008. We need to shift it back to what really happens, what happened in 2008 and why it's different now. So, next question. How does the recession impact mortgage rates?
It typically means falling mortgage rates, right? If you go back and look at those same 6 recessions in our country, you see that each time we've seen mortgage rates fall, going all the way back to the early 80s. We live in one of the most foundationally, fundamentally strong housing markets of our lifetime, if not the strongest market of our lifetime. I've been involved in real estate 25 years and I still haven't seen anything like it. I'll give you 2 things to sort of back that up and tell you why I can say that. First one, the current rate on existing mortgages, according to FHFA, as of the fourth quarter of last year, the majority of those mortgages below 5%, right? Over 80% of the existing mortgages are below 5%, over 50% below 4%, right? Some loans that are not going to default, those loans right there, right? People are going to work as hard as they can to keep that mortgage. They can't go out and rent an apartment for what they have their mortgage payment on. And that is a very strong foundation for homeowners across the country, right? Straight up. Second reason I can say that is this right here. Americans are sitting on tremendous equity. 67, almost 68% have either paid off their mortgage or have at least 50% equity. When you break down the numbers, almost 40% of people in this country own their home free and clear. So right? Again, foreclosures should not be happening, won't be happening at the same rate as they have in the past.
That's amazing. So 29% basically have at least 50% equity. That term would be equity rich in their housing. That is an extremely strong foundation for homeowners across the country. The one thing that always reminds me of is back in 2008, people walked away from their homes because they literally owed more on the home than what it was worth. And now, fast forward to this most recent crisis over the last couple of years of COVID and all the things we've dealt with, people have said this: we're going to do things differently. We're going to protect the equity in our homes. We didn't do it right the first time, but we're going to do it right this time. And it's showing up, building an extremely strong foundation for this housing market.
Yep. And the reason it's important we talk about this is because the articles come up and they say, okay, foreclosures are on the rise or prices are on the rise or whatever it is, right? Our job is to combat the negative headlines with the facts of what's actually happening and reinforce those facts with the confidence that we live in a very strong housing market. And as one of the last affordable areas in California, the market in the IE is only going to get stronger. San Bernardino, Riverside, Redlands, the High Valley, the High Desert, all of those areas, values will continue to rise.
And we may not know and can control the things that are happening out in the world, out in the economy, but housing is certainly what we can be the expert on. Why do we do this? We do it for a couple of reasons. One, we want to keep you educated and confident. That's our goal. It's our team's goal, really, that you have the information you need to be educated and confident with what's happening. Second, we want to provide you with the most current and trusted housing market insights. Like Robert says, education is freedom, owning real estate is freedom, and this is why we want to keep our clients educated and equipped with knowledge. Thanks for joining us on this monthly market report. I am Yvette Romero.
And I am Robert Carrillo.
And we are Carrillo Group CANY, where we do real estate with purpose.
Peace.